Hello everyone, welcome to today's class. In today's class, we are going to look at something very specific, a major adjustment, which is capital allowance. So what is capital allowance, you might ask? This is a tax relief given to businesses because they have invested in a particular asset, okay? That is basically capital allowance. It's a tax relief given to businesses because of investing in a particular asset. Maybe you buy a vehicle, you buy machinery, and all those things. You have a tax relief for those ones. Okay, so now, why capital allowance? Why capital allowance? Come with me briefly, come close. Why capital allowance? So, why capital allowance? Remember, why capital allowance? Capital allowance, we look at capital allowance because remember, when we are doing our net present value, when we are looking at investment appraisal using net present value, depreciation is not deducted from the profit. All the questions we have been solving, depreciation has not been deducted from what? The profit. So if depreciation is not deducted from the profit, what do you think will happen? If that cost is not deducted from the profit will rise, the profit will escalate. And if profit is high, what happens if you have to pay tax? It means your tax will be higher. Hmm? If profit is high, what happens when you have to pay tax? It means tax will be higher. So because of that case, capital allowance comes in to solve the problem. That tax that has been deducted that is so high, when you're doing now your capital allowance, then you come and solve that problem. You are at par now, you are at an equal level. Well, let's see. Let me demonstrate that in a brief question so that you can see exactly what I mean by what I'm saying. Okay. Now, let's say we have sales. We have one sales. Let's say we have one sales. What is the sales? Oh, let's say sales is $1,000. Okay. Let's have our cost materials. Let's have a cost materials. What can we say materials? Materials $200 less labor. What will be labor up and down? Labor, let's say $300. $300. What next? Variable overhead. Variable overhead, let's say $100. Variable overhead $100. Then let's get a fixed cost. Let's get a fixed cost of $200. Fixed cost of what? $200. So when you work out all these ones, then you do, let's say you have now depreciation. What do you have? Let's say you have depreciation. This is what depreciation. What is the depreciation? Depreciation is $100. Okay, you have a depreciation of $100. So what's the total here? What's the total here? $1,000. You take out $200 minus $300 minus $100 minus $200, oh, then minus $100. What will you have? You get $100. You get profit will be what? Profit will be $100. Okay, this is your profit. Profit will be $100. So let's say tax is 30%. So when you do your tax, 30% will be what? 30% of this one will be 30 $30 will be $30 will be what? $30 will be $30. This is your tax. Okay, because there is depreciation, your tax is what? $30. Are you seeing it? Your tax is what? $30. Well, let's say now in doing your NPV question, there is no depreciation. You forget about depreciation. Depreciation is not there. You don't even forget about it because in calculating NPV, you don't consider depreciation. Let's see what will happen to the tax. Let's see what will happen to the profit and then the tax. So the same figures, you have sales, the same figures you have, the same figures you have. So you have these same figures here, sales. So you have these same figures here. But remember here, depreciation, after fixed costs, you have depreciation. Depreciation here now is what? Zero. You forget about depreciation as you do in your net present value. So here, what do you think will be the profit? The profit here basically is $200. This is your profit. Now, 30% tax. So 30% tax on it. 30% of 200. 30% of 200 is going to be 60. $60. So you see your tax is high. Your tax is what? Higher. Your tax is what? Higher. You see your tax is what? Higher. You see your tax is what? Higher. So look at these two figures. So because of this, capital allowance is given. Capital allowance is what? Given. When capital allowance is given, okay, it will now set this one off. Okay, basically in our NPV, this is in our NPV, this is how we do it. Okay, we forget about what? Depreciation. And because we forget about depreciation, tax becomes higher. So if tax becomes higher, then what will happen to our profit? But let's see the questions I will solve. Let's solve examples of capital allowance. So capital allowance, in solving capital allowance, you need 5 things. In solving what capital allowance, you always need 5 things. How many things do you need? You need 5 things in solving capital allowance. Okay, you need what? 5 things. You need 5 things. So now capital allowance example. So yes, before going to the example, you can say capital allowance. Capital allowance is basically saying the excess tax. What's the excess tax? Excess tax is 30. The excess tax is what? 30. So we are saying how to get the excess tax. So excess tax, you're going to say depreciation expense times what? Tax rate. What was the depreciation expense that we did here? What was the depreciation expense? It was $100. Eh? It was $100. This one times tax 30%. Gonna give you $30. So that is the excess tax. The excess tax, and we are going to add it back. So now, looking at this question now, this example now, this example is saying, this example is saying, how do we do for capital allowance? Let's say we have investment of $100, $1,000. We have life. Was life 4 years? Life is 4 years, and capital allowance. The method is straight line. Method is what? Straight line method. Method, we can say straight line. Scrap value. Scrap value is what? $100, and scrap value is $100. Then tax 30%. So as I said, in doing capital allowance, you need five things. No matter the question, pick out five things from them, from the question. One, investment. Two, life. Three, capital allowance, the method. Four, scrap value if there is any. And your tax. So you make capital allowance schedule. You make what? This is the solution. You make what? Capital allowance schedule. No joke about it. Capital allowance schedule. So here you have years. You have years. You have capital allowance. Okay, this is straight line. Then tax savings. What's tax savings? What's your tax 30%? Tax savings. So here you find your depreciation. What is going to be your depreciation for a year? Here depreciation, we have done depreciation. Always to find the depreciation, you know exactly how you're going about it. So first you have year one, two, three. How many years? 4 years. So remember, what's the depreciation per year? You're always saying, you're always saying, look at this one, you're always saying life of the asset. Yeah, you're always saying investment minus scrap value divided by the number of years. By the number of years, 4 years. So life of the investment is 1,000 minus scrap value 100. 100. This is 100 less than 4 years. This one, what would this one give to you? So basically, when you do this one, you have 225. You have what? 225. Basically, when you do that, you get 225. Basically, when you do this one, you get what? 225. Okay. 225, you get what? 225, you get what? 225. Now, you get 225. So, the life of the asset at year one, at the beginning of year one, with 1,000. Now you have taken, so here, now you have taken, you can get your net book value here. The net book value at the beginning was 1,000. Then you take 250 from it, 225 from it, 225. What will be the net book value going to year two? 225 minus. So it will be 1,000 minus 225. It will give you the net book value, going to give you 7.5. Early year two. Early year two, but you have not taken out year two depreciation. But now take out year two depreciation. Take out 225. So when you take out year two depreciation, you say year two now 225. What would be the value for year three? Going to year three, you take out year two depreciation, you get 550. Early year three. But in year three now, you come again and take out depreciation of 225. Come again and take what? Depreciation of 225. So 225 minus. So here, coming year four now, your net book value for early year four will be what? 325. 325. That will be your net book value for early year four. But before taking out year four depreciation, you take out the scrap value first. Then the balance that you can charge. Balance in charge, okay? The balance you can now charge. Can be balance in charge of balancing allowance. Now, what's the scrap value? The scrap value is 100. So you take out the scrap value, the remaining is what? 225. When you take out the scrap value, the remaining is what? 225. When you take out the scrap value, the remaining is what? 225. When you take out the scrap value, the remaining is what? 225. When you take out the scrap value, the remaining is what? 225. Good. You have taken out the scrap value, so you charge the rest 225. This is a capital allowance using straight line method. So what would be your tax savings? Here, tax savings 30% of 225. 30% of 225, it will give you 67.5. So since it is the same year, and this is a straight line, so it all seems to be 67.5. This is the example of capital allowance using straight line method. Okay, now let us look at another one again. Let's look at another one. So you have investment. You have what? Investment. What's the investment? Let's say $2,000. What's the life? 5 years. $2,000, 5 years. Tax rate. What's the tax rate? Tax rate is 30%. Same year. Okay, tax rate is 30%, same year. So capital allowance, it's at a straight line. Okay, straight line method. So is there any scrap value? 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 You can say scrap value. Scrap value is 300. $300. This will be your scrap value. Listen again. Listen again. Listen again. So this is example 2. Listen again. Always make you need 5 things for capital allowance, be it straight line or the other one we are going to. Now, you make capital allowance schedule. So you make what? Capital allowance schedule. You have here, you have capital allowance, you have tax savings. What's the tax? 30%. Okay, you have tax savings. Listen, how many years have you? 5 years. One, two, three, 4, 5. You have 5 years. Now, this is straight line, very simple. So what's the investment? What's the investment? Straight line, very simple. What's the investment? What's the investment? The investment is what? $2,000 minus scrap value. What's scrap value? 300 upon life. Upon what? Life. Upon life of the asset. What's the life of the asset? 5 years. So here you left is 1,700 upon 5 years. Don't you think so? 1,700 divided by 5. 1,700 divided by 5 years. What would you get? So your depreciation per year, your depreciation per year will be what? So your depreciation per year will be 3,400, 340. Okay, $340. That's your depreciation for the year. So now the life of the assets at year one, what's your net book value? At year one, what's your net book value? The net book value of the asset is the worth of the asset, 200, $2,000. For year one, you did a depreciation. What's the depreciation? 400. What's your depreciation? $340. When you take out $340, what will be your depreciation? Be the net book value for year two? What will be the net book value for year two? So coming to year two, the net book value is going to be 1,660. That will be the net book value for year two. So you take it again, year two depreciation. So going to year three, the net book value for year going to year three will be 1320. You take away depreciation again. Take away what? Depreciation. 340. Going to year four, what will be the net book value? Going to year four, the net book value will be the NBV minus the depreciation for year three. Okay, 340. The net book value for year three will be 980. That's the net book value for year three. Year four. Year four. Now take out year four depreciation. Take out what? Year four depreciation. What's year four depreciation? 340. Remember, it's a straight line. So 340. So going to year five, early year five, the net book value early year five will be what? Minus 340. The net book value early year five will be 640. That's the net book value. But is there any scrap value? Remember, at the final year, remove the scrap value, then the remaining can charge. Okay. Now, is there any scrap value? Yes. Scrap value. What's the scrap value? 300. What's the scrap value? 300. Remove the scrap value, so you're left with 340. That 340 you can bring again 340. Now, it's the same year. So 340, your tax savings on that one, 30% of it, you have for year 102 throughout. 102, 102, 102, 102. Basically, that's what you have. Okay, let us look at one more example. Let us look at one more example for capital allowance. So you have another example here. You have another example here. Let's say investment $1,000. Investment is what? $1,000. Life is 4 years. 4 years. And scrap value, is there any scrap value? Scrap value is $50. Scrap value will be $50. Capital allowance, straight line, straight line method. What do you need next? Tax rate, tax rate 30%. Tax rate is 30%. So basically these are the 5 things you need. This is another example. Now is a solution. Okay, solution. So capital allowance schedule, years 1, 2, 3, 4. 4 years. Capital allowance, tax savings. Was tax 30%? Now your asset is what? What's your asset? What's your scrap value? Always come here. Your asset, your scrap value. Your asset is 1,000. Scrap value is 50 upon life 4 years. Okay, so this will be 950 upon 4 years divided by 4 years. 950 divided by 4 years. 950 divided by 4 years. Now let's change something here a bit, slightly. Let's change something here a bit. Instead of straight line, let us make it, in arrears. Okay, so it is in arrears. Pay attention on what we mean by arrears. Okay, capital allowance is claimed in arrears. What's your depreciation for year? The depreciation for the year will be two 237.5 dollars. $237.5. So year one, so what? NBV. NBV, what's your NBV? What's your NBV? Your NBV is $1,000. Your NBV is what? $1,000. Your NBV is what? $1,000 at year one. Your NBV is $1,000 at year one. So you take out depreciation there, 237.5. So $1,000 minus depreciation of 237.5. Your net book value coming to year two will be 762. 7 will be what? 762.5. Take out depreciation minus depreciation minus 237.5. What will you get coming to year three early? Coming to year three early, you get 525. The early year three, take off depreciation minus 237.5. You'll be left with the depreciation here will you okay, here the depreciation will be 237.5. When you take off the depreciation, you'll be left with 287.5. Early year four. But what happens with this NBV? Early year four, there is a scrap value. What's the scrap value? $50. So when you take out $50, you'll be left with 237.5. This 237.5, bring it for year four now. 237.5. So now pay attention. In arrears meaning the tax savings, the tax savings is not claiming that year. Meaning the tax savings is not claiming that year. You have to go 1 year. Okay, so what is here in year one will be paid in year two. So now what is in year one times 30%? So you have in year two now, you have calculated here you have calculated, here you have year one, you have calculated 30%. 30% of it, they're gonna give you 71.25. But what will happen? You pay it. This one you have calculated, you pay it in year two. This one you have calculated, you pay it in year three. This one, so on. Okay. So you have here 71.25. What you have calculated in year two, you pay it in year three. What you have calculated in year three, you pay it in year four. And what you have calculated in year four, you have to pay in year five, 71.25. That is what we meant by in arrears. Okay, this is your capital allowance. So briefly, let's solve the question. Let's solve the problem. Copy this one, then we'll solve the problem. Okay, we will solve the problem. We'll work out a solution. We'll solve a problem. So I hope you're done copying that one. We're back. So yes, we solved the problem. Specifically, a problem now. Let's address a problem. Let's address a problem. So we're going to address a problem. Okay. So we are saying, let's have an example here. Let's have what? An example. Project costing. So example, project cost. What's the cost of the project? Project cost $300,000. Discount rate 12%. Discount rate is 12%. Discount rate is 12%. Machine will be sold for $220,000 in year four. In year four. In year four. Working capital So this is a question. Project cost $300,000. Life of the project 4 years. Sales, you have 5,000 units each year. Selling price is $30 per unit in the first year, rising by $20 per unit. Materials is $5 per unit. Labor $2 per unit. Fixed overhead is $10,000 per annum. Tax rate is 30. Same year. Discount rate is 12%. Machine will be sold for $20,000 in year four. Working capital of $5,000 will be invested at start. Capital allowance is straight line. Okay, straight line. So find NPV. Find what? Find NPV. So in this question, the first thing you do when you are given a capital allowance is to what? Prepare a capital allowance schedule. When you are given a question that has capital allowance, prepare what? Capital allowance schedule. So capital allowance schedule. Capital allowance schedule. So now in solving for capital allowance schedule, how many things do you need? 5 things. So one, say investment. What's the investment? The investment in this question is $300,000. Okay. What next do you need after investment? You need the life. What's the life? The life there is 4 years. After life, what next do you need? The next thing you need after life, you need scrap value. What's the scrap value? Scrap value $20,000. Okay, scrap value is what? $20,000. That's the scrap value. The other thing you need, what next? The method, eh? Method is straight line. And lastly, you need tax. What's the tax? 30%. These are the things you need to take out. So your capital allowance schedule, you need these things, okay? So yes, in preparing your capital allowance schedule, you need these things. So now you say yes, you need years, you need capital allowance, you need tax savings, 30%. This, remember, it's the same year. Don't forget that one. So here, year one, two, three, four. Okay, year one, two, three, and four. Year one, two, three to four is what you need. And you have 300,000 minus what's the scrap value? 20,000 upon the life of the years, the life the life of the asset. It's 4 years. So this is going to be 280,000 divided by 4. What do you get? 70 for each year. So here, your net book value for year one, still you have your 300,000. Ali, you still have what? Your 300,000. Ali, do you have what? Your 300. You have your 300,000. Take out your depreciation. Coming to year two, Ali, you'll get what? 210,000. 210,000. Take out the depreciation. 70 again. Coming to year three, Ali now. Yeah, the third year, Ali, you get, when you take off your depreciation from there, you get what? You get what? So you get 140, Ali. Then it's 140 again. Ali year three. What will happen? Ali year three. This is year two. Year two. You took out the depreciation. Okay, year two, you took out the depreciation. In year three, you're taking off the depreciation. 1 minute. Year one, you took out the depreciation 30. Coming to year two, year two, you took it out. It remains this 140. In year three, you have taken off the depreciation. It remains 70. Wait. Let's see something. Yeah, take out 70 again. Okay. So now let's go back. Something here did not add up. Let's go back. Let's go back. So your net book value is 300. What's your depreciation year one? 70. Now from that 300, take off 700, 70,000. So your net book value coming to year two, it will be 230. Early year two. When year two, you use the assets, it depreciated by 70,000. So 70,000 in year two. So you, by the end of year two, coming to early year three, that balance again, you took it from the net book value. So you were left with 160 early year three. So year three again, you took 70% depreciation. Okay. But coming to year four, early year four, your net book value for early year four is now what? Minus 770. Your net book value for early year four is 90,000 NBV. But what's your scrap value? The scrap value is 20,000. So you're left with again, in coming to year four, you're left with 70. So 30% of these 70s, what will you get? 21. 21. So your tax savings 21, tax savings 21, tax savings 21, tax savings 21. So this is your tax savings. This is first, the first thing you need. This is the first thing you need for you to solve your 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 NPV question. Okay, for you to solve your NPV question. So take notes. Let's do something. Take notes. So now I want to take a note. Let's now solve NPV. Okay, let's now solve for NPV. So now solving for NPV, we have, we always do a table, right? Ouch. We always do a table. We always do a table. Good. We have our table. How many years have we? We have 4 years. So you start with zero. Start with what? Let's bring it further here. 0, 1, 2, 3, 4 years. 4 years. What's the investment? The investment is $300,000. $300,000. Now, if the investment is $300,000, what's the revenue? So revenue, you say what revenue? Revenue. How do you get revenue? So now look at this one, revenue. You can say we want to solve for revenue. You have 1, 2, 3, 4 years. Okay. Now your sales per year, unit sales per year, you have 5,000 each year. Okay, 5,000 each year. You were having 5,000 units each year. Pay attention, 5,000 units each year. What's the selling price per unit? Selling price per unit. In the first year, it was $30. $30, rising by $2 each year. So this will be 32, this will be 34, this will be 36. Then you have to multiply them. Remember, these are in thousands, okay? The units are in thousands. Take note. So when you do that one, the first one you get here, revenue will be 150,000. This will be 160,000. This will be 170,000. This one will be, the revenue for year 4 will be 180,000. 180,000. That's your revenue. Good. From revenue, the next thing is materials. Okay, materials. What's the cost of materials? Materials in the question is $5 per unit. $5. It's not rising neither falling. $5 per unit. Okay, $5 per what? Unit. $5 per unit. $5 per unit. Are the units fixed? Yes, the units are fixed. So materials, year 1 will be $25,000. $25,000. $25,000. $25,000 and $25,000. Okay. For materials, what do we have next? We go to what? Labor. Labor. Do we have labor? Yes, labor. Labor is labor. What do you have next? We have what? Labor. Labor. Now, what's labor? Labor is labor is labor is $2 per unit. Not rising neither falling. So because of that, not rising neither falling, you have $2 per unit. 2 times 5,000, you have 10,000. 10,000. You have 10,000. You have 10,000. Okay, labor. What next? After labor, do you have any other thing? Yes, you have fixed overheads. Fixed overheads. Fixed overhead seems to be 10,000 throughout. Fixed overhead seems to be what? 10,000 throughout. 10,000 throughout. 10,000 throughout. 10,000 throughout. 10,000 throughout. Yes, you have these ones. From this point, what do you do next? From this point, you need your taxable profit. You need what? Taxable profit. You need what? Taxable profit. So, before you consider your taxable profit, you bring your investment, $300,000. That's your investment. So, your taxable profit, when you calculate this one, year one, you will get 105,000. Okay, that will be year two. You get 115,000. Year three, you get 125,000, and year three, you get 135,000. Okay, that's your taxable profit. Okay, that's what your taxable profit. What do you do next? What do you do next? Taxable profit. What do you do next? Taxable profit. Then you calculate tax. What's tax? Tax is 30%. 30%. Taxable profit 30%. 30% of 105,000. 30% of 105,000 it will give you 31,500. Remember, tax is paid in the same year. Okay, tax is paid what? In the same year. Tax is paid in the same year. This one will give you 34,500, and this one will give you 37,500, and lastly, the last one will give you 40,500. Okay, 40,500. That's your tax. Hmm? That's your tax. That is what? Your tax. That is what? Your tax. What happens next? Are you done? No. In the question, we have scrap value, we have working capital injected. That's what's happening in the question. But remember, the scrap value, working capital, or whatever we have that is not part of our operating business has to come after tax, after deducting tax. You don't bring them before deducting tax. Okay. So we have a scrap value. Scrap value. They are saying the asset was sold in year four. Okay. Look at the question. The asset was sold in year four. Look at it. Scrap value. Scrap value of the asset. The machine will be sold for $20,000 in year four. That's good. So scrap value, just say scrap value in year four. You come to year four, scrap value. Look at it. Look at it. Come here. Year four, scrap value is what? Year four, scrap value is what? $20,000. Scrap value $20,000. Remember, when we sell asset, money comes in. Our concern is with cash flow. So because money is coming in, it's a positive on us. It's a plus on us. So now look, scrap value. What next? What next? You injected a working capital. What next? You injected a working capital at start. Okay? What happened? You injected a working capital at start. So if you pour money, money is going out. So working capital. Okay, working capital of what? What's the working capital? $5,000. So $5,000 working capital. You borrow the money. But what happens to working capital? Whenever you inject a working capital at start, okay, whenever what you inject a working capital at start, you need to take out working capital at close. Whenever what you inject working capital at start, what do? You take off working capital at close. That is what you do. Working capital at start and take off working capital at close. So at close, year four, you inject working capital at start, then you take the money, and the money coming in, taking out the money, it means the money is coming in, okay? It's cash inflow. So at year four, working capital will be you pour the money, you receive the money again at close. So next, lastly, there is a tax savings. There is what? A tax savings. Tax savings, remember you did tax savings. Year one, you got 20,000. Remember? Year one, you got 21,000. Come here, come here. Look at this one, tax savings. So you see, year one, tax savings, year one, year two, year three, year four. You remember they are in thousands, okay? Tax savings. So you bring them, tax savings 21,000, year two 21,000, year three 21,000, and year four 21,000. Okay, tax savings, tax savings. This is how you do your tax savings, your tax savings, your tax savings, your tax savings, your tax savings. Now, is all done? Yes, all done, all done, all done, all done. So what do you do? Here you have your NCF, net cash flow. So your net cash flow here going to give you 305,000, okay, for your investment. So when you do for year one, what will be your net cash flow? Your net cash flow is going to give you 94,500. 94,500 to give you what? 94,500. And year two, what will that give to you? 100 and 101,000. So it will give you 101,500. And year three to give you 108,500. 108,500. And finally, year four, it will give you 140,500. Okay, 140,500 is what you have. So remember, from this point we need to get what? From this point we need to get our discounting factor. What are discounting factor at year zero? It's always 1. Our discounting factor for this question, remember, it's 12%. Okay, don't forget, 12%. It is what? 12%. It is what? 12%. So 12% at year one. 12% at year one. Go to your table. 12% at year one. Go to your table. 12% at year one. It will give you 0.893. 0.893. Go to year two. It will give you 0.797. 0.797. Go to year three. It will give you 0.712. Go to year four, it will give you 0.636. Yes, that will be what? Your NPV. That will be what? Your NPV. Good. I haven't sort out the NPV. What do you need next? What do you need next? What do you need next? You discount it. So you discount all of them. Yes. So here you need next your PV. Okay, you need what? Your PV. What do you need next? Your PV. What do you need next? Your PV. PV still have 305,000 is your PV. Your PV for year one will be 84,000. After calculating, will be 84,388. And your PV for year two will be, after calculating, you get 80 89 5 8089 5. Okay, 8089 5. And your PV for year three, after calculating, you get 77252. And your PV for year four, the last year, you get 89358. 89358. Write that properly. The 893 89 89 358. So what will be your NPV? What will be your NPV? What will be your NPV? So basically your NPV will be basically your NPV will be, after calculating that one, your NPV will be your NPV will be your NPV will be your NPV will be 26 893 26 893 positive, yeah? So that one will be your NPV, accept the project. Accept what? The project. You do what? Accept the project. You do what? Accept the project. To be your NPV, you do accept the project. You do accept the project. You do accept the project. Do you accept the project? Okay. You do accept the project. So take note. Take note. Take note. Take note. Take note. Then we solve one more question for today's class. Then we can call it a day. Take note. Okay, so let's take note. So take notes. Oh, So yes, after taking note, we are here now to solve one last question for our class today. We are here to solve one last question for our class today. Okay, we are here to what? To solve one last question for today's class. Then we can call it home. Yeah. So now, so now, let's look at one very important question. Let's look at what one very important question. Let's look at what's one very important question. So let's look at the question that is right on our screen. Is what right on our screen? Is what right on our screen? We are looking at this question. It is right on our screen. Chamco, 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 right on our screen. Right on our screen. Chamco. Question is right on our screen. Right on our screen. We have a question here to look at. Chamco, right on our screen. What do we have to look at? A question that is called Chamco, right on our screen. Right on our screen. So here we have a question. We can go through briefly. So now, Chamco, a software company, has developed a new games, Fingo, which it plans to launch in the new year, in the near future. Sales of the new game are expected to be very strong, following a favorable review by a popular PC magazine. Chamco has been informed that the review will give the game a best buy recommendation. Sales volume, production volumes, and selling price of Fingo over its 4 years life are expected to be as follows: selling price, sales and production in bracket unit. You have year 1, 2, 3, and 4. You have 450,000, 70,000, 60,000, and 60,000 the other year. Selling price dollars per game. You have $25, $24, $23, and $22. Financial information on Fingo for the first year of production is as follows. You have what is as follows. You have materials, direct material cost 5.4 per game. You have other variable production cost 6. You have fixed cost. You have $4. Advertising costs to simulate demand are expected to be 650,000 in $1,000 in the first year of production and $100,000 in the second year of production. No advertisement costs are expected in the third year and fourth years of production. Fixed costs represent incremental cash, fixed production overheads. Fingo will be produced on a new production machine costing $800,000. Although this production machine is expected to have a useful life of up to 10 years, government legislation allows Chamco to claim the capital allowance of the machine against the manufacturing of a single product. Capital allowance will therefore be claimed on a straight line basis over 4 years. Chamco pays tax on profit at a rate of 30% per year, and tax liabilities are settled in the year in which they arise. Chamco uses an after-tax discount rate of 10%. When appraising new capital investment, ignore inflation. Required. Required. Calculate the net present value of the proposed investment and comment on your findings. Okay. Calculate the internal rate of return of the proposed investment and comment on your findings. Discuss the reasons why the net present value investment appraisal method is preferable to other investment appraisal methods such as payback period, return on capital employed, and internal rate of return. So this is a question. This is a question. I can go over once more. This is a question we can go over once more. Chamco, a software company, has developed a new game, Fingo, which it plans to launch in the near future. Sales of the new game are expected to be very strong following a favorable review by popular PC magazine. Chamco has been informed that the review will give the game a best buy recommendation. Sales volume, production volume, and selling price of Fingo over the 4 years are expected to be as follows: selling sales and production in units, year 1, 2, 3, 4. You have 150, 70, and 60 and 60 for the other years. Selling price per unit in dollars, you have $25, 24, 23, and 22. Financial information on Fingo for the first year of production is as follows: you have direct materials, other variable production cost, you have fixed cost. Advertisement costs to stimulate demand are expected to be $650,000 in the first year of production and $100,000 in the second year of production. No advertisement costs are expected in the third and fourth years of production. In the third and fourth year of production, fixed costs represent incremental cash, fixed production overheads. Fingo will be produced on a new production machine costing $800,000. Although this production machine is expected to have a useful life of 10 years, government legislation allows Chamco to claim the capital cost of the machine against the manufacture of a single product. Capital allowance will therefore be claimed on a straight line basis over 4 years. Chamco pays tax on profit at the rate of 30% per year, and tax liabilities are settled in the year in which they arise. Chamco uses an after-tax discount rate of 10% when appraising a new capital investment. Ignore inflation, calculate NPV, calculate IRR, and discuss why NPV is preferable over the other techniques. So for this question, we are going to do A and B. We're going to do A and B. When we are done with our reading aspects, the advantage and disadvantage of capital investment, appraisal, those techniques, then we can look at the C aspect of it. So now this is the question. Now what? This is the question. It's before you. White before you now. What do you do with this question? What do you do? So the first thing you do when handling a question like this, the first thing you do when handling a question like this, first thing you do when handling a question like this, the first thing you do is to what? Remember our technique. Remember what? Our technique. We're always saying our technique. Remember our technique. Remember what? Our technique. Remember what? Our technique. Remember our technique. Remember our technique. Remember our technique. The first thing you do is to do your capital allowance schedule. Is to do what? Capital allowance schedule. So now you say capital allowance schedule, workings. So here is your what? Workings. Workings. So here you have your workings. Here you have your workings. So whenever you're faced with a capital allowance schedule, whenever you're faced with a capital allowance schedule question, you prepare capital allowance first. And in preparing capital allowance, what do you need? You need 5 things. What do you need? You need 5 things. So you want one, investment. What's the investment? 800,000. Well, what's the investment? Investment 800,000 in the question. What's the scrap value? Scrap value is not given. There's no scrap value in the question. Okay, nobody told us we are going to sell the machine anyhow. So there is no scrap value in the question. What next do you need? From that one, you need what? You need tax. What's tax? 30%. You need the method. Method, straight line. What's the method? And lastly, years. You need what? Years. 4 years. Okay, 4 years. You need 4 years. So this is capital allowance schedule. You have years. You have capital allowance depreciation. Then you have tax savings. Tax savings, this is 30%. Tax is what? 30% in the question. Tax is 30%. You have year 1, 2, 3, and 4. Okay. So early year one, your asset was 800,000, your net book value. Okay, your net book value was what? 800,000. Early year one. But remember here, your scrap value is 0, 800 minus 0 upon 4 years. So you're basically saying each year is 200. Okay, so you know that this year one is 200, the depreciation of 200. So if you use 200 year one, coming to year 2 early, your net book value will be 600. Then year 2 again, you took out depreciation of 200. Coming to year 3 early, your net book value will be 400. You took out a depreciation of 200. Coming to year 4 early, your net book value is 200. This is your net book value. Take out the scrap value. What is the scrap value? 0. You have 200 here. This 200, all you charge 200. Okay. So on this 200, our tax is what? 30%. 30% of 200. 30% of 200. So it's going to give you 60. So tax savings here is going to be 60. Remember, same year, 60, 60, 60. Okay, 60,000. These are in thousands. Okay, they are what? In thousands. Mind you, they are what? In thousands. So capital allowance. From capital allowance, immediately you have done for capital allowance, you move to the next thing, the next agenda. Okay, the next agenda. You move to the next agenda. And what's the next agenda on the list? You prepare your net present value table. Okay, in preparing our net present value table, we need to know how many years. Definitely we know 4 years, and we start with what? Year 0. Year 0. Year what? 0. Investment at year 0. So you say 0, 1, 2, 3, and 4. So at year 4, you have that one. Year 4. So year 0 here, it's the investment. At year 0, what do you have? Investment. At year 0, what do you have? Investment. At year 0, what do you have? Investment. So here you have the investment. Okay, the investment is what? 800,000. Was the investment $800,000? Okay, so you come here, you say revenue. Come here, year 1, you say what? Revenue. What's your revenue for year 1? What's your revenue for year 1? Ask yourself, what the revenue for year 1? So year 1 revenue, year 1 revenue, year 1 revenue will be year 1 revenue. Mind you, revenue for year 1. Mind you, you have 4 years. 1, 2, 3, 4. Okay, unit. Year 1 unit, you have 150. We'll look at the question. Year 2, 70. Year 3, 60. Year 4, 60. You have those ones. So what's the selling price per unit? What's the selling price per unit? Selling price per unit. Year 1, you have $25, $24, $23, and $22. That's what you had. Okay, and $22. You had that one. So now look, you just multiply to get the revenue. Okay, multiply each. So when you multiply each to get the revenue, here you get year 1, you get 375,000. You get 3,750,000. We get 3,750,000. You get 3,750,000. What would you get in year 2? Year 2, you get 1,680,000. 1,680,000. Year 3, you get 1,380,000. 1,380,000. And year 4 you get 1,320,000. Okay, you get this one. So that is what you get as revenue. So from revenue, what do you consider next? Revenue, what do you consider next? From revenue, you have material cost. So material cost. Okay. From revenue, you consider what next? Material cost. What is the material cost? Materials, remember, direct materials. Materials, you have 5.4 throughout. 5.4 throughout. You had what? 5.4 throughout. You had what? 5.4 throughout. So materials 5.4 at 150,000 for year one. Then you do the same thing, you repeat the same thing for year two, three, four, based on their specific unit. Okay? So material cost, when you do that one, you get 810,000. You get 810,000. For year two, you get 300 and you get 378,000, 378,000. Year four, you get year four, you get year four, you get year four, you get year four, you will get 324,000. Year three, you get not year four. Year three, you get 324,000, and year four, you will get year four, you get 324,000 again, the same. You get 324,000. You get what? 324,000. 324,000 is what you get. The next thing, when you're done with labor, when you're done with materials, the next thing you consider is what? Labor. Okay? The next thing you consider is what? Labor. 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 So labor, let's say labor. What is labor? Labor year one. Labor year one, you have the next thing you consider is labor. But let's look at this question. There is no labor here, okay? Don't waste your time. There's no labor here. So, yes, labor will not work here. So you take off this one. There is no what? Labor here. If labor was there, then okay. But labor is not there. So what do you consider next if labor is not there? You look at the next cost, the variable cost. Variable cost. Variable. So variable cost. Okay. Variable cost. What's your variable cost? Your VC. Let's have it up here. Your VC. VC for year one. Your VC. Your VC for year one will be what? 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 Year one, your VC variable cost is $6. Okay, $6, $6, $6, $6 for year one, your variable cost. So year one, your variable cost will be $6. So $6 at each one. It's your variable cost. When it comes to your variable cost, $6 at each one. You will get first you get 900,000. So you're going to say $6 times 150,000 gives you 900,000. So $6 at 70,000, it will give you 420,000. Okay, fixed costs, variable costs at year three, it will give you 360,000. 360,000. 360,000. This is 360,000. And finally, the other year it will still give you 360,000. To give you 360,000. Okay. So after variable cost, what do you have next? In our question, we have fixed cost, fixed overheads. Okay. Fixed overheads. What is fixed overheads? Now, Remember, fixed overheads is saying $4, okay, per unit. So the first year we have 150 units, 150,000 units. What do you think this will be? This will be 600,000. Okay, this will be what? 600,000. But you might think that yes, you have different the year two, the unit decreases, year three, the unit decreases, year four, the unit decreases. Yes, it's true. Though they decrease, though they decrease, remember you already set the pace. Hmm? You already what? Set the pace for year one, and it is based on unit produce. So that same fixed costs, you have it throughout. There is no need to change it. Okay, there is no need to change it. It should not vary with these ones. So because you have already set the pace and it is based on the production capacity, you have adjusted your fixed cost to that, then you're just gonna consume all these ones at the same rate. So now fixed cost 600,000. Okay, there's no need to change it. 600,000, 600,000, 600,000. Okay, so you have it this way, 600,000. What is the next cost? You are told that, okay, you are told in the question that in the first year you incur advertisement cost of 650,000. Okay, advertisement cost of 650,000. In the second year, you the cost was 100,000. See that? So advertisement cost, ADV, that is the advertisement cost. Okay, advertisement cost, ADV, advertisement cost. So that advertisement cost in the first year is 600 and to simulate to what? Stimulate demand. So in the second year it was 100,000. Okay, the second year it was 100,000, and nothing in the other years, and nothing in the other year. So are all the costs done? You look. Yes, definitely all the costs are done. You're done with all the costs. So what do you do next? Next, you check for your taxable profit. Hmm? Taxable profit. Taxable profit. So you call this taxable profit. So your taxable profit always bring what? In your taxable profit always bring what? The cost of your investment. Okay, the cost of your investment. So taxable profit is revenue minus all these costs. For year one, revenue minus all these costs. For year one, revenue minus all these costs. For year one, revenue minus all the costs, be it material, labor costs, overheads, and advertisement costs. When you do it for year one, your taxable profit will be 790,000. 790,000. Okay, that will be your taxable profit. And for year two, your taxable profit will be 182,000 to be what? 182,000. And for year three, your taxable profit will be 96,000. 96,000. And for the final year, your taxable profit will be what? For the final year, your taxable profit will be what? 36,000. 36,000. That will be your taxable profit for the final year. 36,000. Your taxable profit for the final year. 36,000. From taxable profit, what do we need next? From taxable profit, what do we need next? From taxable profit, what do we need next? We could calculate our tax. Our tax is what? 30%. Tax is what? 30%. So 30% of tax is paid in the same year. Remember, tax is what? Paid in the same year. So 30% of tax, 30% of tax will be 30% of tax will be for this one, the first one. For year one will be 30% of tax. 30% of tax will be 237,000. 30% tax. 30% tax will be 237,000. And also the other one will give you 50 54,600 tax. And year three will give you 28,000, 28,800. And final year will give you and the final year will give you and the final year will give you and the final year will give you 10 800. Yes, you have your tax. What next after tax? What next after tax? Is there working capital management? No, there's no working capital management in the question. Is there scrap value? No, there's no scrap value in the question. The scrap value is 0. Okay. Is there tax savings? Yes, there is tax savings. What is tax savings? After calculating our tax savings, capital allowance, remember? Tax savings, capital allowance, when you calculate, we have 60,000 each year, okay? We got what? 60,000 tax savings. That's a plus. $60,000. Remember, what is the tax savings about when we are doing capital allowance? Previously, earlier, I explained in this video or in the previous video saying that tax savings, it is based on, when we are doing a net present value, we don't deduct depreciation, so that escalate what? Profits. And because profit is being escalated, our tax goes up higher. So to correct that figure, we do it in capital allowance. Okay, for better explanation on this one I'm doing now, you can go to the previous video, you can go to the earlier video, you can go to the beginning of this video again. I think it's already there for you to get the understanding about capital allowance. So now, from capital allowance, is there any other thing? If there is no, I don't think there is any other thing. So what you have to do from this point, what you will have to do from this point, what you will have to do from this point, at this point, you calculate for your net cash flow. Okay, calculate what? Your net cash flow. What do you calculate? Your net cash flow. So in the rule, net cash flow is net cash flow. So your net cash flow, you bring again the worth of your investment. So your net cash flow year one, your net cash flow for year one, after calculating, you have 613,000. You have what? 613,000. 613,000. Then you have 170. Well, 187,400. You have that one. Then the other one you get year three. Year three you get 127,000, 127,200. And year three, year four, final year, year four, you get 85,200. Okay, that's what your net cash flow. So from your net cash flow, what do you need next? Your discounting factor. In this question, discounting factor is 10%. Okay, What's our discounting factor? 10%. Our discounting factor is 10%. Our discounting factor is 10%. So 10%. So at year 0, it's always at year 1, 9.09, at year 2, 0.8, 0.8, at year 2, it's 0.826, at year 3, 0.751, at year, that's at year 3, at year 4, it's 0.683. Okay, so now your present value. Now what's your present value? Now what's your present value? Now what's your present value? You calculate your present value. What is your present value? PV. What's your present value? At year 0, the worth of your investment, you bring it. At year 0, the worth of your investment, you bring it. So you bring it. You bring it. And when you discount that one, year 1, you will get, when you discount year 1, you get 557217, 557217, 557217, and here you get 5154, 154792, 154792, and here you will get 955, 95527.2.2, and lastly you get 50. Lastly you get lastly you get lastly you get lastly you get 58 19, 58 19, 1.6. Okay, so what's your NPV? Your NPV will be, now to do all and subtract. What will be your NPV? Your NPV will be what? To do all and subtract. What will be your NPV? Your NPV will be what? To do all and subtract your investment. So when you do all those ones and subtract your investment, you get 6.5. You get what? 6.5. You get what? 6.5. You get what? 6.5. You get 6.5. Your NPV will be 6.5 7 657 to 8.2. Okay, so this project is accept. You accept the project. Okay, you accept the project. So this is your requirement number 1. Okay, your requirement number 1. So take note about this one. What do you do? Take note about this one, then we can look at the other one. Internal rate of return. Take notes on this one. We can look at internal rate of return. Returns. Accept the project. Take notes on this one. So you can also just check for this question on BPP. You'll be able to get this Chamco, or you browse for it. Chamco, you can be able to download it. Okay, you can be able to download this question, or just check for it on BPP. It's available if you, but it's already here. I think it's readable for you as well. So Chamco, this is the 8th part of it, the 8th part of it. So you can pause it and copy, from which you proceed. So let's look at the final aspect of it. So let's look at the other aspect of it. Now, the other aspect of this question is saying we want to do what? We want to do IRR. Is looking at IRR. What is it looking at? Internal rate of returns. IRR. What did we say in our last class? The formula for IRR is what? A plus A plus A in bracket A as the numerator, A minus B in bracket B minus A. So what's A? A equals to the rate, lower rate, and B equals to higher rate. A equals to NPV of lower rate. B equals to NPV of what? Higher rate. So this is what you have. So immediately after doing it, you just insert and do your NPV, okay? You just insert and do your NPV. So good. Now, in looking at our NPV, so always when doing NPV, always you look at the net cash flow. Haven't used a rate that is 10% and you have a positive NPV, know that the next rate you should use is what? The higher rate to get a negative NPV. The rate and also the NPV, they don't move, they move in opposite direction, they don't move in one direction, okay? The lower the rate, the higher the NPV. Okay, the lower the rate, the higher the NPV. And the higher the rate, the lower the NPV. So NPV and what? The rate, they move what? In opposite direction. So immediately you have an NPV that is a lower rate that gives you, immediately you have an NPV that is a positive. It is because the rate is low. So for you to get a negative, you must go for a higher rate. And doing IRR equation, and doing IRR, you need a lower rate, you need a higher rate, you need a positive, you need a negative NPV. That is what you do. So here we have an NPV that is 10%. We have what? Discounting factor that is 10% and with its NPV. So what do we go for? Next, we go for NPV that is 20%. So bring your net cash flow again. Your net cash flow, 800. Yes, your net cash flow. Yes, I repeat, bring your net cash flow. 613,000. Bring 187,400. You bring 127,200. And lastly, you bring 85,200. Yes, you bring those ones. Remember? You bring them. So your discounting factor this time around will be 20% because you want to do for NPV. So you go to your table, 20%. 20% on your table. When you look at your table, 20% discounting factor for year one will give you 0.833. Okay, discounting factor for year two will give you 0.694. Discounting factor for year three will give you 0.579. Discounting factor for year five, for year 4 will give you 0.6 482. Okay, that is what it will give to you. Discounted factor for year 4. So you do this one. Your next step is to say, okay, you discount. This will be your PV. Okay, your PV. So your PV still investment remains. Okay, now for year 1, what will be your present value for year 1? You have 5, 10, 5, 10, 6, 5, 10, 6, 2, 9. And year 2 you will get 1300 and 1300, 5, 6. And year 3 you get year 3 you get year 3 you get 736, 736. You get 736 for 8.8. Okay, 736 for 8.8. That's what you get. And the next one you get 41066.4 is what you get. So when you do all these ones, your NPV, when you do all of it, your NPV, what will be your NPV? What will be your NPV when you do all of it? What will be your NPV when you do all of it? What will be your NPV when you do all of it? Your NPV will be your NPV will be your NPV will be your NPV will be minus 600. Yes. So here, now here, remember, now here, remember, now here, remember. First, the line you use, don't forget this net cash flow. This is what you use, net cash flow. The same net cash flow, you use this net cash flow, okay? In discounting is what you use. So you want to do for your IRR. Now it's time to do for your IRR. So now, how do you do for your IRR? So here, the lower rate, what's the lower rate? 10%. Okay? Lower rate equals to 10%. Higher rate, 20%. The net present value of the lower rate, what is it? 65, 7, 2, 8, 2. And net present value of the lower rate minus higher rate minus 4, 600. Yeah, that's what you have. So now it's time for you to solve for your NPV. It's time for what? You should to solve for your IRR, internal rate of return. So you know this the formula. All you need to do is to insert these figures into the formula. You're gone. Pam. So now, you're going to say IRR. You're going to say IRR. IRR will be the A. It's going to be 0.1. That is 10% plus 65 plus plus 65 plus 8 plus 65 what? 65 728.2. 65 728.2. You get the plus all over what? All over 65,728.2 minus in bracket minus 4,600. Okay, times what? Times 10% minus 20%. 10% 0.2 minus 0.1. It's going to give you 0.1. It's going to give you 0.1. So you solve this one. Okay, you solve it. Remember here you observe board mass. What do you observe? Board mass. What do you observe? Board mass. Don't forget. Okay, you do board mass. What do we mean by board mass? Definitely, you have to obey the signs, all the signs, BOD, MAS. You have to first, what do? Bracket of division. If is there any bracket here? Yes, there is bracket here. You clear this bracket, and when you are clearing this bracket, what will happen to this one? This sign will change, so this one will be a plus. Then what will happen? This sign will be what? Plus. From there you divide. When you divide, you multiply first, then you multiply first, then you can now add last. So what will happen when you do that one? You will end up getting something like this. You end up getting something like this. You end up getting something like this. You end up getting something like this. Okay, let's still do it as we are doing it. You end up getting 6572 6572 plus 44 plus what? 600. Good. So this one you say here over 700, so we 0.165,728.2 divided by 11032.8.2 times what? 0.1. Okay, so you say what? 65,728.2 divided by 11. This one will give to you here. You get, when you come here, you get 10.1 plus 0.595 0.59575 times what? 0.1. So all you need to do is to do this first. Okay, you get 0.1 plus 0.059 0.0595. Okay, so this one you add it plus 0.1, it's gonna give you 0.159575. So yes, what do you do now? This is 15.95%. Basically you can say this one is almost 16%. This one is almost 16%. So this is your IRR. This is what your IRR. Now, this is what your IRR. Now about the question. 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 So about the question, we said the other one, we are going to discuss it when we treat those other topics. So basically, this is your IRR, internal rate of returns. Okay, your IRR, internal rate of what returns is what your IRR, internal rate of returns is what your IRR, internal rate of returns. So your IRR, internal rate of returns. So the decision on IRR, the decision on IRR is saying this one exceed our cost of capital, so accept. Okay, you accept the project because the decision there says whenever your internal rate of return exceeds the cost of capital, then you accept the project. Okay, so that is it about IRR. So thank you for today's class. Make sure you share this one to other students. You like, subscribe to my channel so more of these videos, whenever I post them, you'll be able to see exactly. Thank you. Love you. Bye bye.